Okay, now I started the recording. Hello everybody, so welcome to our today's topic for financial accounting about liabilities, chapter 8 and 9. Chapter 8 is about current liabilities and chapter 9 is about long-term liabilities. So we already know what a liability is, but now we're going to elaborate with more specific features of the liability. So liability are defined as a present obligation of the entity that result from past transaction and which will be paid with assets or services. This is the technical IFRS definition of liabilities. The three key words are obligation. A liability is a debt or an obligation for the company which result from past transaction. What does it mean? What does it exclude? The fact that a liability should result from past transaction. So it may look obvious, but to make sure we understand the meaning of these features of the liability, the best question is, what does it exclude? Considering that a liability should result from a past transaction, what kind of event cannot give rise to a liability?
I think I would best be able to respond to what it includes basically. Then we just infer what it excludes. So for what liability would include, that would be any transaction that had to do with suppliers or customers that has not been fulfilled or completed. So maybe with suppliers, it would be accounts payable, any supplies that have not been paid for, and then for customers, it would be any upfront payment that the goods or services have not been delivered.
Yeah, specifically the past transaction requirement means that any project or future order cannot give rise to a liability. If you just book an order from your supplier and there is no invoice, that will not give rise to a liability. So there should be an obligation that results from a past transaction. The transaction has already been done in the past, and it will be fulfilled by payment of assets or by performance of services. Either we pay assets. What is the most common asset used to fulfill a liability?
Cash.
Cash. Okay, but it could also be paid by any other assets and also by delivery of services. Now, the classification of liability on the balance sheet is either a current liability or a non-current liability. Current liability or short-term liability is the liability that is going to be settled within the coming year. IFRS uses the current terminology. ASPE uses the short-term terminology. Current versus non-current liability, this is an IFRS terminology. Short-term versus long-term liability, this is an ISPE, accounting standard for private entity terminology, but just a difference of semantic difference, but the meaning is the same. Most liability are recorded as they occur during the accounting period. So this should be a present obligation to fulfill the the liability. So now another kind of classification Beside the classification, the chronological classification, long-term versus short-term, we also classify liabilities into those liabilities that can be determined with accuracy. We have an invoice, an account payable. I have to pay for utilities or for gas or for a purchase. There is an invoice. There is no estimate. That kind of liability, which is not subject to any estimate, and the amount of the liability can be determined with accuracy. That is what the regular liability. That is the account payable or salaries payable, wage payable, tax payable. Um, um, those are the liability that could be determined uh, with accuracy. There are also liabilities that must be estimated, subject to estimate, because there's no way we can determine by it means with accuracy the exact amount. Okay, we cannot determine exactly the amount, so we have to make accruals. So this is we have to make an estimate and account for those accruals for transactions that occur during the accounting period. And those liabilities are referred as provision. For example, liability for warranty. Okay, one may say, okay, why should I recognize a liability for warranty? Let us just wait until the customer returned the goods, the damaged goods, and then instead of making an estimate of what would be the warranty, we just get the exact amount of the repairs we're going to make to the damaged goods and then recognize those exact amount. Why should we make an estimate to the warranty and recognize it even before it happens?
I would think most importantly, first of all, is a regulation. I think the IFRS requires it. But practically as well, it makes sense because, I mean, a sale is not, if there's already a provision for warranty, wouldn't be able to presume that there would customers wouldn't take advantage of the, something could happen within the warranty period and customers want to utilize the warranty. So it makes sense practically, even though also it's an IFRS requirement.
Mhm. Can you use the definition of a liability to answer this question?
So it's an unfulfilled obligation. It's unfulfilled obligation from the definition of a liability,
Mm-hmm.
and that could have happened in the future.
It comes from it results from a past transaction. What was the past transaction?
A sale.
The sale. And it will be paid with an asset or a service. For example, service repairs, a repair service, right? In the future. So as you can see, in this definition, there is no indication that the fact that in order for a liability to be recognized, it should be determined accurately with accuracy, or we should be able to get the exact amount. So there is no requirement. So any obligation which is a debt and which result from past transaction and which will be paid with asset or service has to be recognized as a liability, no matter whether you can whether you have an exact amount, accurate amount of it value, or an estimated one. So the fact that we do not have an exact amount is not one of the criteria for an obligation to be required to be recognized as a liability. That's why if you have a commitment as a company to make a warranty, to provide warranty to your customer for their sales, in case there is damaged goods, you have a commitment to repair them, then based on the matching principle, where that commitment, the expense of the repair, have to be recognized during the same period where the sale revenue was recognized, and because there is a commitment from your side to make those repairs, even though you don't know the exact amount of those repairs, you have to recognize them as a provision, as a liability, provided that you can make an estimate of their amount. One may say, okay, but if I don't know the amount, how can I make the estimate? Okay, so that is not a big deal. So just base it on statistics, based on your historical data, the database of the company, you can make an estimate. Usually there is a 5% risk of return of damaged goods from our sales. So you can use that percentage to make an estimate and recognize your liability, debit, liability, warranty expense, credit, warranty provision. Okay. And there is a third kind of liability, what we call contingent liabilities. Those liabilities, they may not be there may not be possible to make an assessment for them. That becomes a contingent liability, and if the liability is qualified as contingent, then it will not be recorded as a liability in the balance sheet, but it has to be disclosed as a disclosure on the financial statement. For example, one of our previous employees that were fired engage in a dispute against us, and our lawyer is not able to assess or to estimate what would be the compensation, if any, the company has to pay to those fired employees. In this case, if the lawyer say there is no way for me to make an estimate, that would be qualified as a contingent liability, and as a consequence there is no journal entry to recognize it, but there is a requirement to disclose this dispute on the financial statement as a disclosure within the notes or disclosure of the financial statement, the narrative disclosure, not as a part of the not in the body of the balance sheet. Any questions so far? So first classification is based on the age of the liability, whether it is current or non-current. Second classification, it is based on to which extent we can determine or estimate the amount of the liability. Those liability who can be determined, those are account payable, tax payable, wages payable, accruals in general, and those liability for which you have to make an estimate, their value or their valuation is based on an estimate. Those are qualified as a provision, and provision should be part of the body of the balance sheet. It should be recognized as a liability in the balance sheet. And if there is a risk to have an obligation to be fulfilled, but we cannot estimate the amount, that is a contingent liability. Contingent liability is disclosed in the disclosure and will not show up on the balance sheet. So let's get back to the accruals, the current liability, regular ones. So they include account payable that result from the purchase. They include accrued liabilities that result from the use of telecommunication service, as an example, or of course, accrued payroll and benefit. If in case stored value card for Nespresso, for example, as an example, where you can pay in advance forfeited amount. So that is what we call like an example of stored value card. That is also a liability, since the company will have to fulfill to render the service or the good related to those cards. So these are example of current liability. The most famous one are account payable, that result from the purchase of goods or services on credit. And this is what we call either account payable or account or trade account payable. Account payable turnover ratio is one of the famous ratio you may decide to use in your project report, of course, because you are limited by a total number of around 10 ratios. I do not expect you, and you should not make your analysis in your report based on the full list of ratios we're going to cover, but you have to make a selection of what you consider according to your professional judgment as a more relevant ratios. For example, if you decide that account payable turnover ratio is relevant for your analysis, then you will have to calculate the AP turnover for both of your companies and then compare them, and then the highest turnover ratio would be the better or the best among the two companies. How to calculate the AP turnover ratio? Numerator, cost of sales, that you take from which financial statement? Income statement, divided by the denominator average account payable. Where did you get this information? Average account payable.
Financial position.
Two balance sheet, the two consecutive statement of financial position. Statement of financial position, let's say December 31st, 21 and December 31st, 22, for example. The opening balance of the account payable plus the ending balance divided by 2. That is the average account payable. And immediately when you calculate this, there is another, even if it is not presented here in the slide, another ratio that comes with this, which is the days, the number or the average days to pay. It means you would divide 365 by your turnover ratio, and that gives you the average days to pay. So it means if it is 23, for example, that means that in average, the company takes 23 days to pay its account payable. If you compare this with a company that takes 29 days to pay, that means that the one which pays at 29 days can get more liquidity and than the one which pays in 23 days, to compare the two companies. So, accrued liabilities are expenses that have been incurred before the end of the accounting period but have not yet been paid. It includes, for example, income tax payable. So you have to wait until the full year is completed, is finished. Then you calculate the income tax and then you recognize them as a liability. Sales tax is also as an example of accrued liabilities, and the payroll liability, wages payable for the work that have been performed by employees during the period but not yet paid. It will show up as an accrued liability. And also all the payroll deduction, withdrawal for income tax from the employees, for example, or any retirement deduction, or any other, for example, also employment insurance deduction. All of these kind of deduction are liabilities that will show up in the balance sheet of the company. Example of accruals. Unearned revenues or deferred revenues is also another kind of liability, which is not subject to an estimate. You receive, for example, a deposit from your customer that is an unearned revenue that should be recognized as a deferred revenue as per the revenue recognition principle, where the revenue is not recognized during the period where cash has been collected. It should be recognized during the period where goods have been delivered or service have been rendered. So the compliance with this revenue recognition principle will result in the deferred revenue or unearned revenue, which is a kind of current liability. Any questions so far? Now, when you make a sale to your customer and the sale is in credit, if you decide that you need your customer, your client to sign a note payable, so that should be accounted for not as a AP, but as a note payable. You have to use a specific account for notes payable. Payable, it means, sorry, I'm wrong in here. I'm talking about the purchase, not about the sale, okay? So we are talking about notes payable. So when you buy from your supplier on credit, and if your supplier requires to sign a note payable for you, which is a note receivable from their side, then that note payable has to be accounted for in a separate, should not be mixed with the account payable. Account payable should be dedicated only to those liability that are not materialized or not supported by a note payable. The note payable usually has an interest rate and it has a specific day for payment. That's why we need to account for note payable in a separate account, not to mix them with account payable. In order to calculate the interest on the note payable, so simple mathematical formula: the principal of the amount times the annual interest rate times the number of months out of 12. So if we have a note payable of $1,000 with an interest rate of 5% for a period of 120 days, 4 months, so the interest would be $1,000, the principal times the annual interest rate, we said 5%, times the number of months out of 12 times 120 days, which means 4 months out, divided by 12. So it would be $50 multiplied by 4 out of 12, so $50 divided by 3. Okay, it means let's say 17 or 19, $17, let's say, interest for that period. So this is how we calculate the interest on the note payable, and we recognize that as an interest expense. So debit at the day of the purchase, debit inventory, for example, credit note payable $1,000, and then at the day of the settlement, debit note payable $1,000, and debit interest expense $17, and credit cash $1,017. This is how to account for the settlement of a note payable. Any question? Okay. Another example of current liability. If you have a long-term debt over 20 years, mortgage over 20 years, for example, you are required to show the portion of that 20 years mortgage which is required to be paid on next year. Okay, the current portion of a long-term liability has to be presented as on the current liability portion of the balance sheet, not on the non-current liability portion. I have a $1 million of a loan of $1 million for next 10 years, and I have to pay $100,000 within the next year. So my balance sheet has to show $900,000 as a long-term liability and $100,000 as a current portion of a long-term liability. The current portion of a long-term liability, which is the portion of the long-term liability that is going to be paid within 12 months, within the next year. We need the user of the financial statement to be aware of any immediate or any payment which is required within 1 year, even if it is related to a long-term debt. Am I clear here? Any question? So now we've finished with the accruals, those kind of liabilities that are based on accurate calculation of the amount, okay, not based on estimate. And now let's elaborate a little bit on the provision. Provision, we said, those kind of liability that are where they fulfill all the criteria for a liability. They are an obligation, present obligation, resulting from a past transaction, and that they will give will be settled with either services or assets. However, their amount, their value is subject to estimate. It is not a determined amount. So because the three criteria of the liability are met, then we have to recognize them on the balance sheet. Example, estimated liability for warranties, estimated liability for product returns and allowances, estimated liability for legal and tax disputes that arise in the ordinary course of business, closing of stores or specific operation, and the restructuring of the production. These are examples of liabilities that are subject to estimate, and the fact that we cannot determine the exact amount will not prevent us from showing those liability as a liability in the body of the balance sheet, not through disclosure like the contingent liability. And the last category, we said contingent liability, which is an obligation where it is likely to happen as an obligation, possible liability that is created as a result of past event, and which may or may not become a recorded liability depending on the future event. That is what we call contingent liability. It includes lawsuits, it includes environmental problems and tax disputes. These are all kinds of current liabilities. Any questions so far? One of the very useful calculation or items that are actually not part of the financial statement, but very useful for financial analysis is the working capital. There is nothing in the balance sheet which is called working capital. However, for financial analysis purpose, financial analysts would make this calculation, which is simply the current asset minus the current liability. One of the first calculation you make. And there is also the working capital ratio, which is current asset divided by current liability. So the working capital, the absolute amount, the dollar amount of the working capital is current asset minus current liability. What do you expect this amount to be in a regular situation, positive or negative?
You'd expect it to be positive if the company is making money.
Yeah, it could be negative, but that is a very bad sign, right? It is expected to be positive, current asset should be enough to cover all the current liability, because otherwise, if the working capital is negative, mathematically it is possible. We may have the total of our current asset is equal to 1 million, current liability $1,200,000. Okay, this may happen. Okay, what does it mean? It means that we do not have enough current asset to pay all of our current liability. What does it mean? Simply, it means we are going to dispose our non-current asset. We will have to sell our lands, our equipment, our non-current assets, so that we can fulfill current liability. And that is the worst scenario that can happen for a company. That is the first step for bankruptcy. So a regular situation, we should have a working capital which is positive, and a working capital ratio which is higher than 100%. If I calculate the working capital ratio, current asset on the numerator divided by current liability in the denominator, that is the working capital asset, this should be higher than 100%. If it is, for example, equal to 150%, it means that I have enough to cover all of my current liability, and half of my asset is a security margin. I have more than what I need to cover current liability, and that is a good sign. And if I have to compare two companies, company A, company B, with company A that has a 130% of working capital ratio compared to company B that has 170% of working capital ratio, which one is better in favor position? And 30% working capital ratio for A, and 70% working capital ratio for B. Which one is better from this perspective, liquidity perspective? So of course, company B is better because it has more solid liquidity. It has more current asset to cover their current liability. It means the company B face much less trouble in terms of liquidity compared to company A. Yeah, quick asset, quick ratio. So what we have elaborated here is the working capital ratio. Okay, working capital ratio means all of the current asset divided by the current liability. However, banks may require not only the working capital to be higher than 100%, the quick ratio, which is a smaller amount of the asset, because it only includes this quick asset, not all of the current asset. It excludes the inventory. Quick assets includes the cash and short-term investment as well as the receivable, which means it excludes the inventory. So one may say, I have a good working capital. You get to your bank and ask for a loan. You say, okay, let's make an analysis of your liquidity, and you may say, okay, my current asset exceed my current liability by 20%. I have 120% of working capital, so I'm good. The bank may say, wait a minute, your numerator includes inventory, okay? Inventory is not something you can immediately convert into cash. You cannot pretend being able to use inventory to pay your current liability, because converting inventory to cash is not completely under your control. Okay, even if converting account receivable to cash may be under your control, but that does not apply to inventory. Show me your quick ratio, not your working capital ratio. your quick ratio, to which extent you are able, just using your cash and receivable without including your inventory, to which extent are you able to pay your current liability. So this is the quick ratio, and it shows that to which extent the company is able to pay. That's why the word quick, which means quickly, in case all of the current liability becomes required immediately for some reason, how quick are you able to respond to that immediate requirement, which means if you used your cash and the receivable only without using your inventory, would you be able to pay 100% of your current liability? So this is another indicator of liquidity for the company, which is very common, especially by banks. Any questions so far?
Yes, sir. It says there that if it's too high, though, it suggests inefficient use of resources. So if we're actually looking at the quick ratio, is there a rule of thumb range that we should be looking for, or is that a judgment call that's made each time that
Okay.
the company gets analyzed?
It is a hard question in means in if you take it absolute in general. However, for your project, for example, since you are comparing two companies, A and B, it is an easy matter. So the best one is the one who has the best quick ratio. That's it. So, and if you compare the same company for 2 consecutive years to see whether the quick ratio improves or declines, that is an easy to compare. Otherwise, there should be a standard for every field, for every industry. So depending on the kind of industry, the field of expertise of the company, you may have a specific range where quick ratio is considered to be either normal or not normal or high or low. Does it make sense? So again, for your project, it will be very easy. You have company A, company B, you calculate the quick ratio for both companies, and then the best one is the company who has the highest quick ratio. Okay, so let's move forward. Now, as part of the liabilities, the current liabilities matters. A present value calculation. It applies for current and non-current liability also. This is a very common kind of calculation, specific financial mathematics for accounting people, where we always have to bring a future value to its present value, future amount to its present value. Let's say you have to pay $100,000 within 2 years. So there is a technique to calculate the present value of that $100,000. Within 2 years, it is worth $100,000. If you make a present value calculation, it may worth, of course, lower than, let's say, $85,000, for example, depending on the ratio, the rate you used for your present value calculation. So we're going to elaborate a little bit on the present value calculation, which is useful in many matters in accounting. You can use Excel for your present value calculation. There is a specific formula in Excel to calculate the present value calculation. So just give me 1 second, please. محمد أنا حليت الواحد خطأ كان تم حس لا إذا كان سكتوا سكروا ما عادش إذا هم سكتوا إذا نقصوا Ouais, c'est bon. Déjà, ça colle. Sorry about that. So we can use Excel to make the calculation of the present value. There is specific formula function in Excel within the financial function, which is called PV. It returns the present value of an investment of total amount that either a single amount or a series of amount of future payment. So you can just use Excel, and this is how this formula works on Excel. When you click on PV function, this form will show up, and Excel will ask you to enter the rate, 10%, 5%, the present value rate, the discount rate you're going to use to calculate your present value. NPR means the number of payment, the number of periods, or payment or period. For example, if I need to calculate the present value of $100,000 within 2 years, okay, so N would be equal to 2, and payment is the amount, in this case $100,000. You have to fill all three information, and you can also, in case you have information, add future value amount, and the type means you can leave it empty, whether the payment is at the beginning of the period or at the end of the period. If it is at the beginning of the period, leave it empty, and it will systematically consider the payment to be done at the beginning of the period, versus if you need to be calculated at the end of the period, then you have to add to enter 1 in the type, logical value, either 0 or 1, so that you calculate the present value. So this is how you use Excel to make a present value calculation, and we are going to use it with the long-term liability. We're going to make some practice with this. So payment is the payment made each period and cannot change over the life of the investment. This is the formula you use to calculate the present value, and sometimes to account for transaction we need the present value. We're going to make a practice on this. So this covers the topic chapter 8 about current liability. Any question before we move to non-current liability, chapter 9? We're going to use the present value calculation on non-current liability also, and it will bring some clarification to how we use, or why, first of all, why should we use present value calculation to account for some transactions. So non-current liabilities, they are liabilities that means have the same three characteristics of a liability. Can someone remind us what are the three criteria for an obligation to be qualified as a liability? It should be a debt or an obligation resulting from past transaction, and that will be settled in the future, either with assets or with rendering services. So if those that are a long term, not more than 1 year, so we qualify these are a non-current liability, and they have to show up on the balance sheet on the non-current liability portion of the statement of financial position. It will require payment for more than 1 year in the future. And again, if you have a, let's say, a 10 years loan, okay, that is a long-term loan. However, the portion of that loan that is going to be paid within the 12 months, within the next year, it has to be taken from the long-term liability and added to the current liability, because it is going to be paid within 1 year. short-term portion of a long-term or current portion of a long-term loan. The capital structure concept refers to the distribution of the financial of the company between debt and equity. So the financial of the assets, the total asset of a company, of course, it is financed in portion by debt and by equity. So the percentage of debt and equity to finance the full asset, that is what we call as the capital structure. Example of long-term debt, bank loans, the notes, long-term, they can be short-term, but we also have long-term notes payable, mortgage, and the bonds and debentures. We're going to put more focus on the bonds as a famous, popular example of long-term liability. Okay, so terminology related to the bonds. The bonds payable are financial instruments that are very useful for big companies, public companies, and we have to familiarize ourselves with the terminology and the calculation, and the technique to account for bonds. Of course, don't forget that we are dealing with bonds from the perspective of the issuer, not from the perspective of the investor. As an investor, you may decide to invest in bonds. Okay, if you make the decision as an investor to decide to invest in bonds instead of shares, what would be your concern, or what would be the reason for an investor to invest on bonds instead of shares?
That would be to take advantage of the tax.
For tax purpose?
It could also be because a bond will pay you a specific interest rate and you get a definite value at the end, whereas a share can fluctuate and go up and down.
Yeah, go for that. So it means there is more risk with the shares, investment in shares. It can go up and down, yes, but bonds are much less risky. There is no investment with zero risk. Risk is always there. However, in general, investing in bonds is less risky than investing in shares. And as a consequence, if you save in terms of risk, there will be, of course, means your return will be reduced. You cannot expect a high return with investment in bonds. So with yes, as Natalie said, so when you invest in bonds, you're going to receive the interest payment every interest period, every year, or every twice a year, or every quarter. And at the end, at the maturity day, you will receive the principal. So this is from the perspective of the investor, but we are talking about bonds as a liability. So we are talking about the perspective of the company, the issuer of those bonds, the company that issued those bonds on the market. So what would make a company prefer issuing bonds as a mean for financing their activities? Or let me start with another question. What other alternative, what other option for a company if they need to gather financial for their projects? I need $10 million. What are the options I have to get those $10 million?
Basically, a pooled capital structure can either be debt or equity, which is
so first decision to do, should I issue shares? Means I gather that 1 million or 10 million as a contributed capital, or as a debt. Okay, that is the first decision. Now presume that we made the decision that we are going to okay, what is the bad side of this decision? If we decide to gather the money by issuing shares, what is the impact, the negative impact of that?
It reduces the amount of control that the current
Exactly.
shareholders have.
Exactly, you are losing control. So you are means you are involving more shareholders with more voting rights. So you may lose control with that. So if we exclude this option, issuing shares, now the other option is debt. Now, what kind of debts can we? What option within the debt category do we have? We can ask a loan from the bank, right? But we also can issue bonds. How do you compare these two financial tools?
For the loan, apparently, you probably going to just make a lump sum payment at a particular time. And for the bond, obviously, you're going to be required to make the coupon payments, which is incremental payments within the term, and then also at the maturity to repay the principal.
From that perspective, there is not a big difference. In both cases, you will have to make a payment of interest at specific time, and the reimbursement of the principal at the maturity date. Yeah. So usually, the reason why companies will, if possible, prefer issuing bonds is to be under means lower pressure compared to whether having one negotiator with the bank with their conditions and their requirement and also their maximum amount of the loan compared to distributing a big number of bonds to the large public, everybody, me and you and every small or big investors, where the company may have much more control on the condition of the loan. So that is one of the reasons where a company prefer issuing bonds sometimes rather than getting bank loans. So a lot of terminology with the issuance of bonds. A bond has a principal amount. So if the company needs a 10 million, they can split this big amount into small amount of $1,000 each bond. A big number of small amounts so that even small investors, those who do not make trouble to us, can contribute and can buy bonds. So the principal is the amount that is going to be paid back at the maturity date. We call this also the par value or the face value or the maturity value of the bond. The par value or the face value or the maturity value of the bond is the amount that which is going to be paid back by the company at the maturity date. Maturity date means that at the end of the loan period. Okay, 10 years or 20 years, we have to pay the 10 million. That amount of 10 million, in terms of terminology, we call it the principal or the par value or the face value or the maturity value of the bonds. Every single bond have its par value or face value, let's say the $1,000, and usually $1,000 is the most popular par value, and the company will multiply that amount by the number of bonds they need to issue. We also have to distinguish between the two kind of interest rate, the coupon rate and the effective interest rate. The coupon rate is also called the stated rate or the contract rate or the nominal rate. And it is called the contract rate, for example, because that is the rate on the paper, on the document. That is not the effective interest rate that the company is going to afford. However, that is the commitment of the interest rate to be paid at every interest period. It is called coupon rate or stated rate or contract rate or nominal rate. Nominal means not the effective one, and we are going to see what is the effective interest rate. Okay, so example, depending on whether the payments are going to be annual or semi-annual or quarterly. So the coupon rate, for example, in this illustration, the coupon rate is 8%. That is the annual. The coupon rate is always given as on annual per scale, means 8% per year. So if the bonds, the payment is done at the frequency of once a year, annual payment, so the coupon rate would be 8%. With the 8% coupon rate, if the payment is made twice a year, semi-annual payment, January and July, for example, of every year, so the coupon rate, you have to divide it by 2, it becomes 4%. That is the amount of the payment of interest, the cash amount of interest that will be paid every payment period, interest period. It could be also quarterly, where you have to divide the 8% by 4, so that for a bond of $1,000, it will give a raise to $20 of interest every quarter. So that in both cases, in all three cases, you end with an $80 per year of interest until maturity, where the company will have to pay the full amount of $1,000 per bond at the maturity date, I mean, after 20 years or 10 years, or depending on the maturity of the bond. Any questions so far? So we are just familiarizing ourselves with the terminology related to the bonds as an example of long-term liability. So for a bond, the concept you have to understand and to familiarize yourself with is, as we said, the principal amount. For example, Amazon bond, $1,000 is the principal amount, or also called the par or the face value, or the par value, or the maturity value. The coupon rate is the stated rate, 10% in this case, paid semi-annually. So what would be the amount of interest for one bond in one payment? For a specific bond, how much dollar, or what is the dollar amount of interest to be paid in a specific interest day, considering a 10% coupon rate?
Your first payment would be $50.
Exact, $50, because it is paid semi-annually, twice a year. So 10%, $100 per year, because the payment is made twice a year. So $50, that is the cash amount of interest to be paid every interest period. Due in 5 years, that is the term of the bond, which we call which gives us the maturity day. The maturity day is 5 years after the issuance day, and semi-annually, that is the frequency of interest payment. So when the company issue the bonds, they have to indicate on the bonds and the contract the principal amount. that principal amount is not necessarily the amount of money the company is going to collect at the day of the issuance. Okay, it is not necessarily the amount of cash the company is going to collect at the day the bonds are issued, but it is necessarily the maturity amount. At the maturity day, after 5 years, 10 years, 20 years, the principal amount is the amount that is going to be paid back to the bondholders. And we are going to see why the amount which is collected during the issuance date could be different from the principal amount. As a issuer of bonds, as a company who issues the bond, you will have to pay cash interest at every interest day, in addition to the principal that should be paid back at the maturity date, depending on whether the interest is paid annually or semi-annually or quarterly. The reason why the amount of cash the company is going to collect the day of the issuance could be different, and actually not only could be, it is usually different from the face value or the principal, is that there is a difference, or there may be, or there is usually a difference between the coupon rate, which is the stated rate or the contract interest rate, and the market rate of interest, the interest market rate or the effective rate. That discrepancy will create a difference between the principal amount, the maturity amount or maturity value, and the issuance price. The issuance price is the amount that the company is going to collect at the day they issue the bonds. And we're going to elaborate on this. From accounting perspective, as an accountant, financial accounting, we have an accounting principle. Maybe we did not get the chance to discuss it or to elaborate on it yet, which is called the substance over form accounting principle. Substance over form. This is a very famous and useful account principle, which states that if there is a difference between the economic substance of the transaction and the form, then as an accountant we are going to account for the economic substance, economic reality, not the legal form. So the legal form, the principle is called the substance over form account principle. Substance over form, which means as accountant we consider the substance more than the legal form, the economic substance, the economic reality versus the legal reality. The legal reality is what is on the paper, okay, what is on the legal document. In the legal document, the interest rate indicated, let's say, is 5%. So the company is going to pay 5% interest rate at every interest period. However, the interest expense should be accounted for using not the coupon rate, but using the yield rate or the market rate or the effective rate. Yield rate, market rate are the same, are synonymous, means the same, have the same meaning from accounting perspective. The interest rate used to compute the present value is the market interest rate, which is called also the yield rate or the effective interest rate. A company may decide that the coupon rate is 5%, while the market may decide that the market rate is 6%. That difference between the market or the effective rate and between the coupon rate, that is what we call that is the reason why the issuance price may be different from the maturity price, maturity value. The coupon rate is decided by whom? Who decided the coupon rate? Who determined the coupon rate?
The issuer.
The issuer or the lawyer of the issuer, right? How about the market rate? Who decided the market rate?
Demand and supply.
Exact. Very good. Demand and supply. The market. Okay. So there is the market reality that says the effective interest rate for this bond, considering the risk that it presents, it should be 6%. And there is the coupon rate, which is decided by the lawyers of the issuer, which is a stated rate on the paper, on the document, that say the coupon rate is 5%. So we have the legal form, which is on the contract, and we have the substance, the economic reality, which is decided by the market. The accounting principle says substance over form. I disregard the form, the legal form, and I make my accounting based on the economic substance, which means the market. And we're going to see how to make the conciliation between these two realities, because the market, the coupon rate is another reality, because the investors are going to collect the amount of interest based on the coupon rate, not based on the effective interest rate. However, from our perspective as accountant, we recognize the market reality rather than the lawyers or the legal form. And we're going to see how all of this works. When a company issues bonds, we have three possible situations. We may have a coupon rate which is identical to the market rate. Market rate is 6%, coupon rate 6%. We qualify this as issuance at par. This is a very theoretical situation. It almost never happens in reality. It is just used as an illustration for learning purpose, okay? Just for school case or learning purpose, because in reality, it is very seldom, it is very unlikely for the coupon rate to be similar to the effective rate. For the simple reason, to prepare the documentation of a bond, issuance of bond, a process of many months. That process will take many months to be completed. And from the day the lawyers decide what would be the coupon rate at the day of the issuance until the day the bonds are really issued, many things may happen affecting the supply and demand that makes the effective rate or the market rate sometimes slightly different, slightly higher or lower than the coupon rate. So issuance at par almost doesn't exist in reality. It exists in theory only. What do we mean by bonds that are issued at par? It simply means that the coupon rate is equal to the effective rate or the yield rate or the market rate. The most realistic scenario is to have a coupon rate which is either higher or lower than the market rate. When a company issues a bond, the market interest rate will be either greater than or lower than the coupon rate, and that will give rise either to a premium or a discount. So the future value or the maturity value or the principal is the bond is 10 million, but the amount we collect at the day of the issuance is 9,500,000, for example. That is an issuance at discount. The other scenario, the principal is 10 million. The amount we collect at the maturity day is $10,050,000. That $50,000 is a premium. That is an issuance at premium. This happens if the effective rate is different from the coupon rate. So if the bonds are issued at a coupon rate of 10%, and if the market rate is less than 10%, this will give rate to a premium. The bonds, it means the bonds price will be higher or lower than the principal in this case. If the principal is, let's say, 1 million, and if the coupon rate is less, the market rate is less than the coupon rate, this gives also a premium, which means we are going to collect more or less the 1 million principal amount. We're going to, it is an issuance with a premium, so the company is going to collect more than the 1 million. An additional amount, which is the premium. And the reason for that premium is that the market is offering, let's say, 9%. The market is offering 9%, while our bonds are going to pay 10%. So in order for the investor to, so from the investor perspective, if they invest on the bonds on the market, they're going to collect 9%. If they invest in our bonds, they're going to collect 10% of interest, every interest payment. So they have to pay a premium. They have to pay more than the maturity amount. Okay. Now, if the coupon rate is 10% and the market rate is greater than 10%, let's say 11%. In the market, the interest rate, the effective interest rate is 11%, while our bonds only offer 10%. As a company, we have to sacrifice a portion of the principal and collect an amount at the issuance date which is lower than the principal, which means an issuance at discount. Let's say we collect $950,000 instead of 1 million, but we still have to reimburse at the maturity date 1 million, the principal. Is this clear? Any question about this? So I'm not going to elaborate on the issuance at par because it is very theoretical. It almost never happens in reality. It is just used for learning purpose. Issuance at par, it means the coupon rate is exactly equal to the market rate, which means no premium, no discount. Today, at the day of the issuance, I gather 1 million. The same amount, I'm going to pay it back within 5 years or 10 years. If this is the case, that is an issuance at par. And as I said, this is a very theoretical case. In the reality, usually issuance could happen either at premium or at par. Any questions so far? And of course, the yeah, go ahead, please, Natalie.
So if we are issuing bonds as a company, do we want them to be less than the market rate when it comes back to buying them so we can buy them back at a discount? Or am I getting mixed up here?
Ideally, if we have a full control of everything of the market, we would issue our bonds at exactly the market rate, right? So that no premium, no discount. Today, I collect 1 million. Within 10 years, I'm going to pay back or reimburse 1 million, okay? But in fact, this is very hard, difficult to happen. Why? Because, as I said, it is not an immediate decision. Today, I decide the coupon rate. Tomorrow, I make the issuance. Between the day the coupon rate is decided by the lawyers and the accountant of the company, and the day the bonds are effectively issued on the market, there may be weeks or months between these two periods, 2 days, which may have which may affect the variation or the evolution of the rates. So at the day the coupon rate is decided, we cannot expect exactly what would be the market rate within few months when the issuance is done. Am I clear, Natalie? That's why it is not under our control. It is not a matter of it is not a matter of preference for the company, whether they prefer making issuance with premium or no. It is completely sometimes random. It depends on the volatility of the market. It depends of the demand that supplies, which makes the market rate usually be different than the coupon rate. Coupon rate is a decision made by lawyer. Market rate is a decision made by the market, demand and supply, on which the company has zero control. They do not control the market. They control the coupon rate, but they cannot control the market rate. So it is not up to the company to decide to issue at premium or at par or at discount. Usually. Sometimes there may be a conscious decision for the company to make an issuance at premium, but usually this is not a decision or an option made by the company. It is the consequence of the evolution of the market. Does it make sense, Natalie?
Yeah, I understood. I was just wondering if you were a company, I know you can't influence it, the market rate, but if you had a preference for 10 years down the road, would you prefer it to drop so that you could buy it back have it at a discount?
At the end of the day, it will end the same thing. We will see this. Whether it is issuance at premium or at par or discount, it will end exactly the same thing. It gives this will take us to the next slide. So ABC Incorporation issued bonds, $100,000 for illustration purpose, with a 7% coupon rate interest, payable June 30 and December 31st, twice a year. So this is semi-annual interest payment. And the maturity date is December 31st, 2029. Okay, issued on January 1st, 2020. So 10 years maturity bonds. This is on the paper. This is what the lawyers prepared as a contract. Now, if it happens that at the day the issuance is made on January 1st, 2020, by chance, the market rate is also equal to 7%, similar to the coupon rate, that is an issuance at par. No premium, no discount. If at the day the issuance is made, the market rate, the market was offering a 6% rate, interest rate on the market, and we are offering 7%, okay? Our bonds offer 7% of interest. The market, they only offer 6%. This will make the investors willing to pay more than the principal. They would be willing to pay $7,441 more than the 100,000 as a premium. Why is the investor willing to pay that premium? Because they are going to collect over the 10 years, right, 20 times, 1% higher than the market price. And to the opposite, if the market is offering 8%, as a company, I am willing to afford a discount instead of requiring to collect the 100,000, the principal, the future value. I am willing to sacrifice a discount amount and just collect $93,000, which is the par amount minus the discount. Do you see with this illustration that at the end of the day, over the 10 years, there is no winner, no loser in this. Whether issuance is done at par or at premium or at discount, at the end of the day, it would be similar, right? It is a matter of whether you gather you pay more or less now, or you pay more or less at every interest period. Do you see this? So this really addresses your question, Natalie. So whether the company prefers issuance to be made on premium or discount, from business perspective, there is absolutely no difference. If you are in a situation that you gather a premium, so today you're going to gather a premium $7,000 more than the principal, but don't forget that over 20 or over 10 years you're going to pay more interest than the market. While the market is offering 6%, you're going to pay 7% to the investors, 7% more than the market. So you get you win a premium today. That premium will be consumed, or will be consumed over the 10 years. The other situation is you afford a discount today and you gather less than what you are expecting. I was expecting to collect $100,000. Unfortunately, I just collect $93,000, but fortunately, I'm going to pay less interest than the market over the 10 years. I'm going to pay 7%, while the market is paying 8%. At the end of the day, whether the issuance is done at par, at premium, or at sellers, there is no winner or loser. It is it means a zero result game. Can you see this, Natalie?
I do. I see. Like the moment you issue the bonds, it's either up or down, and you just pay up or down, and
then
over the 10-year period,
exactly,
even itself out. Okay.
Very
Thank you.
Okay, so now how to account for all of this? Okay, and how to, and where does this number come from? Why, when the market price is 6% and the coupon rate is 7% and the bonds are 100,000, it ends with 107,000? That is not a random amount. That is a very well calculated using the present value calculation. With this data, if the market rate is 6%, you are going to collect 107,441. That is the result of mathematical calculation. Okay, and also if the market rate is 8%, while you are offering a coupon rate of 7%, with this data, principal 100,000, number of payment 20, it will end with a $93,206 issues. We're going to see how we get those numbers. Let's start with this illustration. On January 1st, 2022, this company issued 6% bonds. What is this 6%? How do we qualify this? The coupon rate. Okay. January 1st, 2022 is what? How do we qualify this day? That is the issuance date. That is the issuance date, the date of the issuance of the bonds, with a par value of $400,000. How do we call this apart from par value? This is called the par value, or also the $400,000 is
Principal amount.
The principal amount. It is also the maturity value, and that would be also the amount you're going to pay on the maturity. It will not change at all. No, it will not depend on the market. $400,000 is the principal or the maturity amount that we are going to pay within 10 years at the maturity date. No matter how much you collected today, Even if you collect, whether you collect less than $400,000 because of a discount, or whether you collect more than the $400,000 because of the premium, at the maturity day, you're going to reimburse $400,000, the maturity value or the principal amount. The bonds mature in 10 years. So this refers to the maturity period within 10 years. So December 31st, 2031 will be the maturity day, right? And interest is paid semi-annually. What does this refer to? This information refers to the interest is paid semi-annually. It refers to the frequency of the interest payment. So twice a year. Okay, so how many interest period do we have? 10 years with twice 2 payments a year. That is how many interest period?
It would be 20, right?
20, exact. 10 years times 2 times a year, so 20 interest period. So N equal 20. When we make the present value calculation, N, the number of payment, is equal to 20, not 10, because these are the frequency here is semi-annually. We make 2 payments a year. So, and what would be the coupon rate for the related to the interest period? The 6% coupon rate is the annual coupon rate per year. Okay, always the given data, you don't need it. We don't need to put it in the warden of the problem. Do not expect the warden of the problem to specify that the 6% is a yearly rate by default. However, in your calculation, we have to convert this annual coupon rate into the related to the proportionally to the interest period. So if the yearly coupon rate is 6%, and if the payments are made twice a year, semi-annually, so the coupon rate for the interest period should be how much? 3%. 3%, right? 3% every 6 months. That is the 6% every year. The market rate is 8% annually. So the market is offering an 8%. The market offers more than the 6% our bonds offer. So in this case, should we expect to receive more than 400,000 or less than 400,000 at the day of the issuance?
You're going to get less.
Less. We have to be prepared to receive less than $400,000 because we are offering to our investors 6% while the market is offering 8% higher than this. So what would make an investor invest in our bonds at 6% while they can get 8% from the market? It would be ridiculous unless they receive a compensation. The compensation is what? Instead of paying us a total of $400,000 today, just pay us less than this. For example, for 380, but our commitment with you is to pay back the principal amount, the full amount, $400,000. Then at that time, the investor would say, okay, I'm losing in terms of interest. However, today I'm winning in terms of what should I invest immediately. I'm going to pay less than the $1,000 per bond. So since the stated rate or the coupon rate or the contract rate is less than the market rate, what other names do we have for market rate? We can call it market rate, or also you really have to be aware of all of these alternative of terminology, because you don't know which which terminology or which name would be used on your exam, for example. So how do we call the market rate? What other alternative to call the market rate? It is called either market rate or the yield rate or the effective rate. They are all synonymous. So market rate, the yield rate, or the effective rate is what the interest rate offered by the market. So in this case, the bond is issued at discount. The issuance price is the result of a mathematical calculation using the present value calculation. So we need to calculate the present value of the future cash flow. And we are going to use the same Excel formula function, the present value function. All we need to do is to enter to fill the form, to enter the data, the required data to make the calculation. So Excel will first require the rate. Here we are talking about the effective rate, not the coupon rate. The rate you have to enter on your formula is the effective rate. Excel is accountant. It does not recognize the coupon rate. The rate is the effective one, the market rate. So in this case, the market rate for a year is 8%. Then the equivalent market rate for the interest period of 6 months is 8% divided by 2, that is 4%. N is the number of payment. So we have 10 years semi-annually. So 2 payments per year, 2 times 10, that is 20. And then Excel will ask you what would be the periodic payment. What are you going to pay every interest period? At every interest period, I'm going to pay the coupon rate. What is the dollar amount of the coupon? $400,000, which is the principal, times 3%, which is the coupon rate. I am going as an issuer to pay to my bondholders $12,000 at every interest period. Right? So that is the payment, the regular payment. And then not required by, if we have it, we can add it. And in this case, we have it. What would be the future value? FV means the future value. What are you going to pay back or to reimburse at the maturity date? We are going to reimburse $400,000 at the maturity date, the full amount, the principal amount. You don't need to indicate the type. As I said, type, you can leave it empty. By default, if you leave it empty, the Excel will consider this as a calculation at the beginning of the period, which means starting the day you issue the bonds, the interest start to run, which is the regular situation. Okay, that's why you can either put 0 or leave it empty. By default, Excel will consider this as a beginning of the period calculation. With this information, Excel will give you the result, the issuance price. In this case, it is equal to 345,638. So if you issue bonds with a principal of $400,000, maturity date within 10 years, semi-annual payment with a coupon rate of 6%, and if the market rate is 8%, converted to 4% per payment, you are going to collect today this amount, $345,644, which means the difference is a discount on the issuance compared to the and another way to present this, some problems, this could be presented with a percentage. So the issuance is done at 86.4%, which means a discount of almost 14%, right? This is how we get the issuance price, and that is the cash amount the company is going to collect at the day of the issuance. Any questions so far? Sorry. Do I have a question on the chat? Okay. So now, how to account for this? So the journal entry to account for this at the date of issuance: debit cash and credit bonds payable for the amount collected, 300 for the issuance price, 345,644. Of course, even though we just collect 345,000, we still have to pay back at the maturity day $400,000, the principal amount, the full principal amount, no matter whether issuance was done at discount or at premium. How to account for the interest payment at every interest day? So first of all, compute the interest, the journal entry. Let me go to the journal entry directly, and then I will be back. This is the journal entry. Look at the structure of the journal entry. Debit interest expense, credit cash, and in the meantime, balance your journal entry with bonds payable. Okay? So before we go to the calculation, to the how do we calculate every amount, let's look, let's elaborate on this journal entry. So at the day you pay $12,000 of cash as interest, okay, that $12,000 of cash interest paid is the cash amount of the interest, and it is not the interest expense. The cash amount of interest is based on your commitment, contractual commitment with the investors. You committed to pay a coupon rate of 3% every 6 months, right? That gives $12,000 of cash amount of interest. That is not the interest expense. That is the form. That is the legal form. The interest expense should be calculated based on the substance, economic substance, the economic reality. The economic reality is the reality given by the market. The amount of interest expense is not $12,000, the cash amount you paid. It should be calculated using the market rate. Market rate multiplied by the carrying value of the bonds. The carrying value of the bonds are the issuance price at the first day, the carrying value of the bonds, the book value of the bonds at the day of the issuance is the cash amount you received at the day of the issuance, $345,000. That is the carrying value of the bonds. You multiply that carrying value by the market rate so that you get the effective interest rate. This is what we call the effective interest amortization method. That is the only method accepted under IFRS. Am I clear? So to calculate the interest rate, the interest expense, you have to multiply the carrying value or the book value of the bonds times the market rate on the debit side. So we debit interest expense based on that calculation. Book value times the market rate. And then we credit the cash amount. The cash amount is cash, so that is not something we can manipulate. The cash amount is really based on the form. It is based on the coupon rate. Your commitment to the investor is to pay 6%. So the way to calculate the cash amount is $400,000, the principal times 6%, and that will never change. Every interest period, it will always be $12,000. The difference between the two calculation, the difference between the economic reality, the substance, and the form, okay, that $1,826 is the amortization of the discount. That is the amortization of the discount, and this is how it is accounted for on the credit of the bonds payable. So the bonds payable, it starts with this journal entry at the beginning. We credit bonds payable for 345,644, and then we are going to keep crediting the amortization of the discount every interest period until, if we make the full amortization schedule, this is the amortization schedule of the discount. As you can see, first interest period, look at the coupon column, the column of the coupon or the face value. It will never change, 12,000 every time. 12,000, 12,000, 12,000, calculated always the same way. Principal times the coupon rate, $400,000 times 3%. That will never change. However, what changes is the interest expense, because the interest expense is calculated based on the market value. That one will not change, and based on the carrying value of the bonds, and that one will change. So on January 1st, 2022, at the date of the issuance, the carrying value or the book value of the bond is the amount on the books, 345,644. And then on June 30, the first payment, interest payment date, we calculated the interest expense, and that, as you can see, the expense is higher than the interest paid. We are affording an expense for bookkeeping purpose, which is higher than what we pay for cash purpose, because of that discount. Because that the fact that we gathered less than the principal is an expense that will be is the total amount of the expense that will be spread over the full period of the loan. So, and how to calculate the amortization of the bond discount? Simply by calculating the difference between the interest expense and the interest paid. 13,000 minus 12,000, 1,826. That will be added to the carrying value through that journal entry on the credit side. It will be added to the carrying value progressively, and we keep doing this every interest period until at the maturity day. Look at the carrying value. At the maturity day, the carrying value of the bond will be equal to the principal amount, $400,000. We are going to keep increasing the carrying value progressively by the difference between the interest to be paid and the interest expense until at the maturity date on December 31st, 2031, we reach the principal amount, $400,000, so that we pay back the book value at that day. Okay, so back to the journal entry. This is how we account for the interest at every interest period. And then, yeah, next year we keep do same thing. Of course, then the interest expense will change because the carrying value will increase progressively. Debit interest expense based on market value and carrying value of market rate and carrying value. Credit cash based on coupon rate and face value. And the balance of the journal entry will be on the credit side because this is discount. Bonds payable on the credit side. And we keep do this at every interest period until we, at the maturity day, the carrying value of the bonds will be equal to the book value. Any question? Of course, hard to understand this just by talking. You have to practice it, and you have practice videos that make this on Excel file. And when you do row by row, you understand the dynamic of this amortization schedule as well as the journal entry. Okay, any question? So from accountant perspective, any problem or in real life about bonds, you first start by calculating the issuance price with the present value calculation using Excel, okay, and then prepare amortization schedule of the discount or the premium. This is how we prepare the amortization schedule. One column for the dates, one column for the coupon, dollar amount of the coupon interest, and that amount will never change. Easy to calculate. Simply multiply the coupon rate by the principal, and it will be the same amount cash interest to be paid. The most complex column to calculate is the interest expense. The way we calculate the interest expense is by multiplying the market rate, not the coupon, the market rate or the yield or the effective interest rate by the carrying value, the last updated carrying value, because the carrying value is going to change from year to year. That's why the interest expense change from year to year. It is not the same from payment to payment. All right. Why? The market rate will never change. However, what is changing here, what is increasing, is the book value or the carrying value of the bonds. We start with the issuance price, and then that issuance price will keep increasing progressively. It will increase every year. By what? By the difference between the interest to be paid, the cash amount of interest, and the interest expense. That difference will increase progressively. That is the amortization of that discount. That discount is a big loss the company afforded, but we have to spread that loss over the useful life of the bond loan in this way, using the effective interest method, amortization method, which is by calculating the difference between the cash amount of interest and the interest expense. If it was a premium, the dynamic is very similar. Okay, if it was a premium, issuance was made the premium. We are going to take the same data, we'll make a small change here. We use the same example, but assume now that the market interest rate is 4% instead of 8%. Remember, the coupon rate is the same, 6%. We started with the first scenario, market rate 8%. Now the second scenario, market rate is 4%, which is lower than the coupon rate. The market is offering 4% only. Our bonds are offering 6%. This being said, investors will be happy to pay more than the principal amount, more than the amount that they are going to collect back at the maturity day. Why? Since the company is going to pay them regularly an interest, a coupon amount of interest, which is higher than what the market offers. If we make the calculation using Excel, we enter the market rate. Now we change the market rate to 2% instead of 4, right? 2% is half of 4%. We keep the same number, 20 payment. We keep the same cash amount of payment, 400,000 times the coupon rate, and the same future value, maturity value of the loan, $400,000. Excel will give you this result, $465,000 for 105, which means $65,000 more than the principal amount. That is the premium, a premium of $65,000 for 105. This is an issuance made at premium. The reason for the premium is that we are offering a coupon rate which is higher than the market rate. The accounting for this is very similar, except that the phenomena here is that the bonds payable on the credit side as a liability will start with an amount which is higher than the principal. When we make our calculation, the issuance price is higher than the principal. So debit cash for $465,000, not only $400,000 because of the premium, and credit bonds payable for $465,000. What do you expect? How do you expect the carrying value to behave, or what behavior do you expect for the carrying value of the bonds, so that we get at the maturity day $400,000, the amount of the principal?
It's going to decrease to drop down to 400.
Very good, excellent, very good. Thank you, Natalie. So when it was a discount, when it was an issuance of at discount, what happens? We started with a carrying value, right? As you can see here, this is the very first journal entry to collect the cash and recognize the bonds payable. Bonds payable was $345,000, which means lower than the maturity date. And we kept increasing this carrying value from year to year, from payment to payment, until at the maturity day we reach $400,000, and that is the amount you're going to pay back. Now, if the issuance is done at premium, we're going to start with the bonds payable liability higher than the maturity, but still at the maturity day we will have to pay 400. So that carrying value will decrease progressively until at the day of the maturity, December 31st, 2031, it will reach $400,000 this way. So the rule is the same. The way you compute the interest expense is always the same. The unpaid balance, or the carrying value, or the last updated carrying value of the bonds, multiplied by the effective or the market rate, and then interest rate is computed always the same way, the face value or the principal times the coupon rate, and the difference is the amortization of the premium. Cash amount of interest minus interest expense, that is the amortization of the premium. So first payment, the first interest expense is the carrying value times market rate, 9,308. The cash amount will never change, always $12,000, whether the issuance is done at par, at premium, or at discount, same thing. Amortized premium is the difference between the interest expense and the interest to be paid. And the journal entry is, because in this case the interest expense is lower than the cash amount, to balance the journal entry you have to locate the bonds payable on the debit side, not on the credit side, so that the journal entry will balance. Credit cash $12,000, debit interest expense for a lower amount of $9,000. In order for the journal entry to balance, we have to debit the liability. What does it mean, debit a liability? Debit a liability simply means subtract a liability, minus, add the subtract the amount, because we have a liability will increase on the credit side, decrease on the debit side. So that's why your bonds payable, as Natalie said, will decrease progressively by the difference between the interest expense and the cash amount of interest, until at the maturity day, as you can see, on December 31st, 2023, the book value or the carrying value of the bonds will be equal to the principal amount, the market value. We start with at the issuance date with $465,000 and go down to 462, down to 469, until at the maturity day we get exactly the same amount as the principal, similar to the issuance at discount. How do we amortize that premium? That premium should be amortized using the effective interest method, which is simply the difference between the cash amount of interest and the interest expense. First time, 12,000 minus 9,308, that is 2,692. That is the amortization of the premium that will be subtracted from the carrying value of the bonds, and we get an updated carrying value for $162,000. This new updated carrying value is going to be used to calculate the second amount of the interest expense, market value times 462, and then we calculate the difference and we keep amortizing the premium that way, which means we are going to reimburse $400,000, but we collected $465,000. We gather an excess value of $65,000. We have to spread that excessive amount into the entire useful life of the bonds progressively by calculating the difference between the cash amount of interest and interest expense. Any questions so far? Okay, so yeah, so the basic difference between effective interest when we compare discount versus premium, this is the phenomena. If we start with the discount, okay, the theoretical case that will never happen in reality is issuance at par. Issuance at par means at the day of the issuance, I collect $400,000. At the day of the maturity, I reimburse $400,000. In this case, no premium, no discount. Presume this was the case. What would be the journal entry every interest period? Debit what for how much and credit what for how much? Presume an issuance at par. At every interest period, what would be the journal entry? Or let's start from the beginning. At the issuance day, what would be the journal entry? Debit cash for how much? Issuance at par. Debit cash for how much?
$400,000.
$400,000. Credit bonds payable for how much?
$400,000.
$400,000. No premium, no discount. At every interest day, debit interest expense for how much?
Whatever interest due or accrued.
Yeah, how much? With the data we have. Coupon rate is 6%. Market rate is also 6%. So debit interest expense for how much? $12,000. Credit cash for $12,000. Balanced. No bonds payable neither at the debit side nor at the credit side. At the maturity day, debit bonds payable for $100,000, credit cash for $100,000. So this is the theoretical case that will never happen in reality. The most realistic case is either we start with the premium and then we start with the par value, carrying value or book value of the bonds that is higher than the principal amount, and then we keep declining that amount, keep declining progressively until it reached $400,000 at the maturity day, or we start with a discount lower than the principal amount that will increase progressively until in all three cases at the maturity day we will end with the book value of the bonds exactly equal to the maturity amount, in such way that our journal entry to settle the bonds is simply debit bonds payable, credit cash $400,000 on both sides, no matter whether the issuance was done at premium, at par, or at discount. Any question? Again, this is a technique impossible to understand without practice. Okay? It looks complex, but if you practice it, you will see that there is a sense, a common sense on it, and it is not as complex as it may look like at the beginning. Yeah, so at the maturity date, on both cases, the journal entry would be debit bonds payable, credit cash for $400,000. Okay. Is this the case for when the issuance done at par? Debit bonds payable for $100,000, credit cash for $100,000, the journal entry at the maturity day. Is this journal entry does it apply to the issuance at par?
Yes, it does.
Yes. Does it apply only in case of the issuance at par?
No, it applies in every case.
Very good.
Yeah.
In all three cases, we end with this journal entry. Whether issuance is done at par, at premium, or at discount, in all three cases, the very last journal entry to settle completely and clear the liability is this: debit, bonds, payable, credit, cash at the principal amount. So that's the technique of accounting for bonds. Now, some ratios for analysis. One of the very common ratio you may decide to include in your report is this time is interest earned ratio. The time is interest earned ratio. In the numerator, we use the net earning before interest expense and before income tax expense. The net earning before interest and income tax, which means net earning plus interest expense and plus income tax, and divided by the numerator of interest expense. It will give us the percentage of earning which we have in excess of the interest expense. In general, a high ratio is favorable, good news for the company. Another very critical ratio, I expect all of you to use this one because very central ratio, the debt to equity ratio, total liability divided by total shareholder equity. It measures the solvability at long term of the company, whether the percentage of the asset which is financed by the liability compared to shareholder equity. Of course, the more this ratio is high, of course, the higher this ratio, the worst is, which is not a good idea, not a good news to have our liability higher than shareholder equity. If you compare two company A, company B, from this perspective, the company that has the lower ratio is in better position compared to the other company in terms of debt to equity.